Hi, Dan Kerr's DK Analytics. Thanks for tuning in. It's December 17th, the day after the big event. The Federal Reserve Board, after 7-8 years of 0% interest rates, has moved the needle up by 25 or almost 25 basis points, 0.25%, so that the Fed funds rate, in essence the interest rates that banks have to pay to lend money to each other, and the crux of all interest rates that go out in the maturity spectrum from that rate, they've raised it. The argument being that the U.S. economy is stronger and gaining momentum. Well, I think anybody on Main Street knows that that's a lot of hooey. And they are doing this in a sense when everybody else around the world is increasingly hitting the QE or the money printing pedal and taking interest rates either down, even into the negative realm, or going towards zero if they're not there already. And this has driven up the value of the dollar to the chagrin of U.S. exporters, obviously, but it has also caused an even larger misallocation around the globe of assets, and is causing tremendous pain and discomfort for a roughly $6 trillion based debt that emerging market countries whose currencies have been suffering vis-a-vis the dollar are having a hard time keeping up with, because payment is becoming much more expensive in their home currencies and principal repayment as well. So there's huge issues there related to the dollar increase and default or in potential insolvency risks that are spreading in sync, obviously, with historically falling commodity prices, themselves a sign of a world economy that is heading into the can. If we take a look at the Baltic Dry Index, we're flirting with 08, 09 lows, if not lower. We have the Chinese economy of the great unwind after 8, 9 or more years of, in essence, artificially based GDP growth, the central planning based, putting 50-60% of every new GDP yuan into fixed structures is absolute nonsense, and that is all unwinding and dragging down commodity prices. So we have a lot of global weakness. Europe, I don't need to mention. Germany, its exports to the East are down in sympathy with the East's stark growth slowdown. We have Europe, the Latin nations, which remain in a quagmire of debt, high unemployment rates, high youth unemployment rates, political dynamite. We also have a Japan that can't get out of its way, having for 20, 30 years doubled down on absolutely insane Keynesian-based policies, fiscally speaking, and supporting them monetarily, in essence, through the money, through the printing press and low interest rates. And the Japanese model, fasten your seatbelts, is being exported around the world. Never mind that it didn't work, but that's what's going on, because the people that hold the levers of power benefit from it, whether it is the cronies or it's the statists, those people that want to expand the size and scope of government to the chagrin and at the expense of the sovereigns in a republic that has codified liberty and property right protections. That's all going by the wayside. Globally, we're moving more and more towards either back towards the USSR or towards, frankly, a fascist business model as led by Putin's or Russia's Putin. And we know what happens when you move away from codified property rights, the rule of law, where the mighty mucks have to obey and abide by the same rules they impose on everybody else. Just think of Congress accepting itself from Obamacare as a good example of where I'm going with this. But we have this toxic public policy stew moving away from liberty, moving away from codified property rights, and more towards cronyism and misallocations resulting from the printing presses of the world able to sustain government spending way beyond tax receipts. In other words, to fund deficit spending and to fund allocations determined by the government's ability to pay for them via the printing press. This is denuding the free market. It's taking away the free market's vibrancy as rules and regulations increase. In the United States, there's 6,000 new regulations filed. We have the whole Obamacare legislation, which was passed by sleight of hand thanks to an out-of-control executive branch as enabled by a judiciary, the Supreme Court, and through a lot of hoodwinks, passed something which is now causing the economy and people, companies, employees a lot of heartache. We have in the United States a tremendous breakdown of this ill-fated Obamacare central planning-based design, whether it is from premiums rising 20-30% for the second year running, instead of premiums falling, they're rising smartly, and the self-pays and co-pays are through the roof. Companies are walking away from full-time employees, expanding their payrolls. We've got the 49ers and the 29ers. Keep it below 50, your workforce, and make sure they don't work 30 hours a week. This is coming together with all the other regulatory insanity, which is a usurpation, really, of property rights. In other words, being able to keep what you earned after you pay your government a 20% or so stake of it. And that is just adding downwards momentum to an economy, both in the United States and around the world, which frankly is long in the tooth in terms of economic recoveries, which last 5-6 years. And it has been a very artificially led economic recovery, not just in the United States, but around the world, and a very tepid one too. In fact, if you took out, if you used an inflation gauge that Main Street can identify with, and not the one that's proffered by Wall Street and the government statisticians, then you could argue that there has been no economic growth at all. That real economic growth has been negative, if not every quarter since 2009 recovery, quote unquote, than most of them. So this is not exactly a great backdrop in which to raise interest rates, even if it's only a small amount. And even if we're not going to get anywhere near a federal funds rate normalization, which over 40 years is between 4 and 5.5%. I mean, the Federal Reserve Board is saying they're going to carefully go towards some kind of normalization. But if we reach 1 and 1.5%, which is loosely their goal, we're still going to be a far cry away from any kind of normalization in the cost of money, and by extension, what savers and pension funds can look forward to in order to sustain the payouts they must make and can't, given the artificially low interest rates that we've been in, the artificial rates that are determined not by the market, but in this case by the central bank on the short end, and most all over the world on the long end too through QE. So what does this mean? We have an economy in the United States which is going from weakness to more weakness, whether we look at orders for the increasingly beleaguered manufacturing sector, beleaguered also because of all the fracking heading in reverse. That's where the most high value-added jobs and growth in the manufacturing sector took place. That is rapidly falling by the wayside. I think that's an open secret, if you will. And we also have orders, whether we look at orders in the manufacturing sector, which is small in terms of the whole economy, below 20%, but very important because it determines a slew of service demand that it either pulls in its weight or takes out because it's not going forward. So we have productivity also under pressure, no surprise there. But if we look at the ISM, whether it's manufacturing or service, they're both heading south. We have 9 months of orders which are heading south. We have actual production output of the manufacturing sector, which is down 1.2%. And we have the situation where, in essence, the American economy, thanks to a labor force participation rate thanks to the full-scale implementation of Obamacare in a corporate sector that is going to get progressively weaker. We don't have the money. The consumer doesn't have the money to go out and buy. Companies don't have the incentive to invest. And costs for the consumer and healthcare are going sky high as the coverage declines. I mean, healthcare costs are 25% or so of an average American family's expenditures. So it's very significant. And I would say that if we take a look at all this, what is inside the United States, globally speaking, what we see is, for a whole variety of reasons, but all of them, in essence, clouded by the move away from the invisible hand of Adam Smith, from sound property rights, from sane regulatory frameworks, to insanity, whether it's the printing press, whether it's codified immigration with full welfare benefits, or whether it's usurpation of property through climate fraud. We're going, and other things as well, we're going in a very, very bad direction if we take a look at what history tells us. So what does that mean? I think the Federal Reserve Board will, and by the way, when we speak of bad directions, we know that the U.S. economy is encumbered by debt factor more than 100%. And people always say, well, debt is over the GDP. We've got debt at 18.5 trillion or so. It's about 110% of GDP. And that typically has been a warning signal. But if we take a look at how actually debt is serviced and repaid, it isn't through GDP, is it? It's through income. And if we see the income that's tally of the American public and what's collected in tax revenues, then in fact we have an issue whereby the tax income of the government is but about a sixth of the debt outstanding, and that debt, by the way, is growing by roughly 1 trillion per annum, and that's before a full-scale recession. If we take a look at Treasury statistics, there's often sleight of hand, which pushes debt out a month or two for political reasons. You can connect the dots yourself. For example, this past November, we have had the federal debt increase in 1 month by over $630 billion. So we've got global issues with debt as well. We have a world that since 08-09 has added some $60 trillion to debt, going up to roughly $230 trillion, which has been growing roughly 10 times as fast as GDP over the same time period. You know, I think you know, of the debt bubbles in the United States, whether it's car loans where cars are sold with nothing down. It reminds me of the housing bubble in 05 through 06. And we have student loans that are also way above the $1 trillion mark. So we've got very questionable paper out there. It's going to take a hit, whether it's in the car loan arena, whether it's the student loan arena that'll have to be written off and funded by the taxpayer or paid through the printing press. Either way, it's not good, obviously, for either savings or growth or price stability. And these things are going to hit the fan, together with junk bonds, which are coming unglued. The spread between treasuries and junk is increasing, and oftentimes there are not even any bids. So all this stuff can come and hit us like a ton of bricks. It just has to have a break of confidence somewhere along this paper-based monetary system, lacking restrictions that we would have had with money tethered to gold and solid free market capital systems protecting property. So where does this take us? I think the Fed will be undoing or capping its rate increase because the economy in the United States and around the world is heading into the tank. There's no way to get rid of the business cycle, especially not an upswing that really hasn't been one, where corporations have been growing earnings per share not through organic top-line growth, but not even through net income, but in essence through financial engineering or share buybacks, where the low cost of interest have allowed them to, in essence, broadly replace equity with debt. And in so doing, not reinvest in growth. So the productivity, which has also been coming down around the world, and adds to the speed bumps and the issues we have because growth without productivity is very limited. And that productivity in turn has been very negatively impacted thanks to financial repression, zero-bound interest rates, and QE. And QE is purchase of government bonds and junk bonds. In other words, you're purchasing assets, or the Federal Reserve Board is, from entities that do not contribute to economic growth or value creation, much less productivity. So all these things, I label them in aggregate a toxic public policy stew. We're heading back into the USSR, as I like to say, tongue-in-cheek, and this suggests to me that the Federal Reserve Board is not going to be able to do much with interest rates. They will have to cap them pretty quickly. I cannot see, given what I've described in the trajectory of a U.S. economy, which could even be weaker than the other major economies, but not recognized as such, thanks to statistical sleight of hand and expectations that have been raised incorrectly by the Federal Reserve and others. But if the U.S. economy, if not even the government statisticians, can dress up a tremendously ugly economic pig as a growing young buck, then I think all bets are off. We have bond vigilantes. We don't only have the Chinese and others that are starting to sell U.S. dollars. We have a move where afoot, if confidence is lost in the U.S. economy and that really isn't growing, and this is all just a facade, then I think we're going to see all hell break loose. And that will pressure bonds, especially junk bonds, potentially also treasuries. Why? Because if people start to move out of the dollar, then what are they going to sell? Well, they hold treasuries and agency bonds in essence. So this is going to create a heck of a storm, globally speaking, and this will virtually guarantee that the Federal Reserve Board will return not only with lower interest rates. I don't think they're going to get to 1 or 1.5%, but after that to QE. Because if we refuse globally to revisit sound economic policies, sound constitutional property protecting rules, and sound regulatory frameworks that cost and benefit analysis instead of politics drives, and that are made for the benefit of the sovereigns and not for the minority, then we will not be able to, either in the United States or globally, Japan is the poster child here, we will not be able to revisit sound economic growth without having sound economic and political policy in place. And we're not going to do that because the people in power have a vested interest. They're getting richer than God in sustaining the unsustainable until it finally falls apart. And the free market, the bond vigilantes, and other people that are being hurt by financial repression, determined to sell and reprice assets in terms that bring solvency risks, inflation risks back on board. Where am I going with this? I think we're going to see a massive reset in stock and bond prices, and this will inevitably result, I believe, in an asset reallocation away from overvalued bonds and stocks and towards scarcity assets, things that can't be printed, that are going to become even scarcer thanks to our misallocations as enabled by financial repression. And those assets obviously also very much include silver and gold, physical silver and gold, outside of the banking system. We have all witnessed silver and gold prices heading down for 5 years or so. A very sharp pullback, but a large part of this pullback, frankly, is artificial. It's because of paper gold, paper silver prices that end up determining the price of these precious metals in a manner that is not above board, to say the least. We have naked short selling in massive amounts of additional sales of paper gold and paper silver that are driving down the price of the metals themselves. This is not sustainable because demand for physical gold and physical silver keep going up. It's moving east. The West is losing its stores, and mines are shutting down because nobody can make money at these rates. Gold and silver through time immemorial have proven to be real money. And I think they will prove to be that again. They still are in many emerging countries, but I think the West will rediscover them by necessity as we end up having to revisit our incredibly non-productive global fiat monetary regime since the post-Bretton Woods period, in effect for 44 years, and falling apart at the seams as debt levels, as derivative risks, as lacking growth, as poor productivity clearly show. So now is a chance for strategic investors to take their cue, to sell what are clearly overvalued stocks and bonds. If you look at stocks based on where the economy is going and where earnings go in a recession, they're easily down 50, 60%. Stocks would be trading in above 40. We have bonds that don't reflect the huge solvency and inflation risks. In other words, is the debtor money good? And how are we ever going to pay back the government? That is the owners of treasuries without printing the money. And that obviously is not going to maintain purchasing power. So if we look at all these turbulences, challenges, we don't have markets, we have manipulations in stocks and bonds. It behooves people to use that as a gift, the manipulation that we currently have, the absolutely insane valuation of government bonds, of most stocks pretty much around the world, and not to mention corporates or junk bonds, which are starting to peel off. We recommend shorting junk bonds. We have this in our pages of the site. We also recommend that you start to sell overvalued stocks and bonds and move into cash outside of banks, get away from misappropriation risks where you can, and also consider adding, if you haven't done so, to your physical gold and silver holdings, again outside of the banking system. Last but not least, we would be remiss if we didn't encourage you to also consider taking positions in a liquid sense, in a diversified sense, in oil assets, both oil and the oil service providers. This is clearly an important area that has been clocked. The oil price is down from over 100 down to the mid-30s in the WTI, yet drilling is taking a big hit. Oil consumption goes up easily 1% per annum over time, even with a weak economy, because that's the only way the population-dominating emerging world is going to get productivity, is through using more machinery. And the same holds also for agricultural assets, where we have the huge erosion in per capita farming land in acreage that is possible to farm. In other words, the infrastructure is in place to bring it from the field to the distributor and on to the marketplace. We have water issues that are very substantial. I think California doesn't need to be explained. And we have an opportunity there as well to purchase scarcity assets that are vital, and assets whenever we move into periods of Cuba revisited, Venezuela revisited, the USSR revisited, which frankly the whole West with its policies is leaning towards being forced towards then those are the assets which tend to go up very much in price. We would be on board both dense energy assets, fossil fuel complex, and agricultural infrastructure assets are very cheap. I don't have to mention gold and silver, which have been manipulated down, as stocks and bonds have been manipulated up. This huge disconnect is going to be corrected, and we're going to have a new valuation environment where market forces reclaim a pricing of assets. And in this process, we think a passport to better future returns and keeping capital is not only to sell overvalued stocks and bonds, especially the high growth, high PE stocks that are really going to get clocked if interest rates go up, but to use this opportunity to set cash aside, to buy cash on steroids, precious metals, again, outside of the banking system, and use those to lock in the value of your portfolio or add to it, and then be well positioned to purchase leading global blue chips. The crony capitalist plays the lux when their dividend yields are no longer 2 or 3%, but suddenly 5 or 6. So we need to go cash. We need to get out of stocks and bonds. We need to revisit sound money for the reset of the global monetary system. And then we will be well positioned to take advantage of opportunities in the stock market that will be provided when a huge revaluation of today's ridiculously valued stock markets allows us to buy blue chips yielding 5 or 6% instead of 2 or 3. We hope you found this of interest and of use. We've just published an article, in fact, on big oil. Will it become the new tobacco in terms of litigation risks? And that ties in well with this topic. Without any additional words other than to say Merry Christmas and Happy New Year, we wish you all a great start into the new year. We hope you find our suggestions and our site, which goes into more details on all these things, in both the reports section and the blog section, of use. That's all from my side. Thanks a lot for listening. Bye-bye.